I was watching this video from CNA Insider YouTube talking about T-bill yields are falling and where else can you put your money? Some experts have commented on alternatives like REITs, which stands for Real Estate Investment Trust, or dividend stocks in Singapore. And this is based on what they mentioned in the video. So I scrolled down to the YouTube comment section and saw this very interesting comment, and it says, a very odd video by CNA. CNA should ask experts on alternatives with similar risks as T-bills. Such alternatives may include the following: Singapore savings bonds, fixed deposit or high interest savings account like OCBC 360, money market funds, topping up CPF SA or leaving money in CPF OA. Example, buy World Stock Index Fund using cash and not CPF OA. If one is buying T-bill, one probably does not want to take excess risk. As such, REITs or dividend paying stocks may not be suitable as they have higher risk. For bond funds, just look at their performance in 2022 to 2023 and see whether you can tolerate the volatility. So this is a very good comment, right? It's well thought out, well written. And I look back at my video talking about how to invest for beginners, and this is exactly what I said there, because in the level 1 section of the video, I mentioned Singapore savings bonds, T-bills, CPFs, and even fixed deposits if applicable. And to put it very clear, REITs and dividend stocks will involve stock picking, because you're picking all these individual dividend stocks or REITs that can help you boost your dividend income. So they will belong to level 4, the highest level of stock picking. And you see, you are jumping the levels from level 1 to level 4, totally skipping level 2 and 3. So I agree with this viewer's comment, because he is right. But I do understand from a media perspective why these experts have to say REITs, dividend stocks, or bond funds. Because to be honest, it will be very boring to talk about all the level 2 and level 3 stuff, and everyone is just repeating it. Might as well jump the gun from level 1 to level 4, the most exciting one, so people can have more eyeballs on this video, right? Anyway, today's topic is just on financial entertainment, and you can join us for further financial entertainment in our 20,000 members Telegram group at Honey Money SG. Join like-minded individuals looking to achieve their personal finance independence. But I want to zoom in on the second part of the comment, right? Who are the people who are buying T-bills right now? The profile and the risk appetite of these people who are subscribing to T-bills in 2025. They probably have low risk appetite, then they are not interested to invest for higher returns, and also not interested in high interest savings accounts due to the multiple requirements like salary credit, card spending, all this, which may not be favorable to their situation. So once you have identified the problem of this group of people, their profile, their background, and their preferences, you need to have a targeted solution. Of course, this is not financial advice, but I want to bring in the first idea, which is micro savings account. When I say micro interest savings account, it's because compared to high interest savings account, they are considered on the lower end. And we are looking at around 2 to 2.5% per annum as of the recording date. So two very prominent examples that I could give. Number one is the GXS savings account. They have the normal savings account, and then they have a safe pocket or boost pocket. And depending on terms and conditions, the interest rate may vary. So as of the recording, I'll put out this interest rate which is accurate right now. Then number two is the Mari savings account. It is highly liquid. You can withdraw it anytime, and they give a fair interest rate of above 2% per annum without any conditions. You just have to put in deposit. You can withdraw anytime. And there's also a trust savings account, which you can look at it at the prevailing interest rate. What does it offer? But you notice all this similarity. They are coming from the new digital banks, and it's the 3 digital banks, right? GXS Bank, Mari Bank, and Trust Bank. They are offering one of the best interest rates without any hoops, terms and conditions, and complicated criteria. And the good news is they are all SDIC insured bank accounts. So they have the proper banking regulation guidelines, and they are ultimately very safe for consumers to deposit their funds. So I do consider these bank accounts as level 1. Right? Because as long as you stay within the SDIC insurance of $100,000, your capital will be guaranteed by the insurance. So that's level 1 for you. Let's move up the level to level 2. Money market funds. I'm surprised none of the experts mention money market funds because they are considered relatively low risk. But what are money market funds first? Based on MAS website, they are specialized unit trusts that invest in high quality, liquid and short-dated money market instruments and debt securities. So they offer slightly higher interest rates than fixed deposits, but they come with an investment risk, which means there's a very small chance that you may lose your capital. Now, some of the more popular money market funds I could give is Fullerton SGD SGD cash fund. It's hovering around 3% per annum as of the recording date, and you may subscribe to it on your favorite brokers like Weibo, Momo, Tiger, and even the most recent hot favorite, Longbridge. Because I guess for Longbridge, they have the most attractive welcome promo for the recent days, like Nvidia share or Apple share, depending on when you watch it and you fulfill the terms and conditions. But to be clear, this video is not even sponsored by them at all. No sponsor. I want to be objective. So you just choose which broker you go with. But I'm just saying, if I'm a new user, I'll go for the one with the highest welcome rewards, and that is Longbridge. Because no matter where you buy the Fullerton SGD cash fund, it's gonna be the same yield. So it doesn't matter which broker you buy it from. It's more like which one would you want to subscribe to, for the short-term welcome rewards or for the long-term where you want to trade and invest in. So you can make your own preference. Then another popular money market fund is Phillip Money Market Fund. Because unlike the Fullerton SGD cash fund where it takes about 1 work day to withdraw, Phillip Money Market Fund offers a same-day withdrawal. And I believe the cutoff time is like 10 a.m. So if you submit your redemption before 10 a.m. on Singapore time, you'll receive it by the end of the workday. Albeit, Phillip Money Market Fund do offer a lower yield compared to Fullerton SGD cash fund. But it's an exchange on the liquidity, right? You can do same-day withdrawals. So that's an advantage that you can have. And based on my experience, I know that I could subscribe to Phillip Money Market Fund through Poems. That is like their flagship cash management solution, which is the Poem Smart Park. And another broker that offers this is Tiger Brokers, because Phillip Money Market Fund is also the default or preferred option if you look at the Tiger Vault, which is their cash management solution. But money market funds being level 2, I would say that it's not like a long-term place to park your funds and keep earning all those yield investment returns. It's more like a temporary area to store your funds before you get ready to execute your investment orders, because you want all these funds ready, but since you deposited in, you want to get some yield on it on your idle funds and not waste any opportunity cost. Alright, so it's to get you ready for investment. It's not for you to deposit funds inside and then wait for passive income for the long term, okay? Because the money market fund use will fluctuate according to the market sentiments. So if we move up the ladder, we need to talk about level 3, which is investment returns. And level 3, I will talk about ETFs, being exchange traded funds, or index funds, which tracks the index. Now, if you're a beginner starting out investing, don't know what to invest in, you're scared you put all the money into one stock and then the stock crashed the next day, then what you could do is to diversify your risk by investing in many multiple companies. And that's how ETFs do it for you in a basket of diversification. So it's more suitable for people with lower risk appetite. For example, if you want to look at Singapore market, there is the STI ETF, ticker ES3, which tracks the top listed Singapore companies, and then you can invest in all of them using this one ETF. For global exposure, you may look at VWRA, which tracks the MSCI World Index, and then if you want US exposure, you may look at S&P 500 ETFs like the CSPX. But CSPX, being an Irish domiciled fund listed in the London Stock Exchange, is not available on every broker. So one broker that I really recommend to use is Interactive Brokers, which you can scan the QR code right here or click the link below. It's one of the best brokers with the best exchange rates and long-standing history that you can trust. So this is what I'm personally using when I want to invest in the Irish domiciled funds. And I also got no sponsor for this video lah. So if you click on the link, it's like support the channel, because every click counts. So thank you to all those who have clicked. But to wrap it up, picking individual stocks involves analyzing the company business and reading financial reports. It is not so easy to commit, especially if you do not have any financial background prior to this. Otherwise, if you're just jumping into investing in REIT, investing in dividend stocks, you are speculating because you have no idea what you're investing in unless you know how to read all these reports that analyze businesses. You're just hoping that it will work out in the long term, but I can tell you from past experience that hope is not a strategy. If you hope, nothing will happen. Even if you hope, the outcome may not be favorable to you. So I know that T-bill yields are bad and falling, but before you jump the gun and head into investing in REITs or dividend stocks, you have to do your due diligence. Make sure to assess your risk tolerance and not go in blindly. I would suggest to go up the ladder instead of just jumping to level 4. And if you want a clearer guidance on how to invest for beginners, I already made a video which you could check it out, how to invest for beginners, right here.